Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone.
Glad to be here.
We are really jumping into the data stack today. We're pulling from sources like the CNBC Daily Open, some fresh Bloomberg analysis, and reports coming out of the UK exchange.
And we have to, because the market signals are just pulling us in completely opposite directions right now.
Exactly. So our mission for this deep dive is to try and untangle these threads. You've got these contradictory economic indicators here in the U.S. on one hand.
And on the other, these really dramatic and I'd say potentially inflationary geopolitical events that are unfolding in the energy markets.
It seems like a very tricky session for you, the listener, to navigate.
It really is, because the biggest stories today feel almost custom-made to just confirm whatever bias you already have.
Okay, so what do you mean by that?
Well, on the domestic side, you have this U.S. jobs report where, the strength and the weakness seem almost perfectly balanced. It's a Rorschach test.
And then globally.
And then globally, you have this very serious resurgence of geopolitical risk coming from new sanctions on Venezuela and these looming threats against Russia's energy sector.
All right, let's unpack that domestic puzzle first, because this U.S. labor market report for November really is a masterpiece of contradiction.
It is. So at first glance, the headline number looked pretty strong.
Right, non-farm payrolls increased by a seasonally adjusted 64,000. That easily beat the 45,000 forecast. So that's acceleration.
That's the bullish flag right there. It suggests the economy is holding up. But here's where, as the CNBC Daily Open highlighted, the analysis just immediately gets murky.
The unemployment rate.
The unemployment rate. It actually ticked up unexpectedly to 4.6%. And for the bears out there, that's the highest rate we've seen since, September 2021?
Yeah, that's a number that's hard to ignore. It suggests there are some underlying cracks starting to widen.
So if you're a trader and you've been betting on economic weakness, you are laser focused on that rising unemployment rate.
And you're also pointing to the fact that the job numbers for October were revised down, right? They actually shrank a bit.
Exactly. For that camp, the narrative of a slowdown is, fully confirmed.
But then you have to listen to the other side.
And the other side argues that the increase in the unemployment rate wasn't because people were losing their jobs.
It was because the labor force grew.
It grew. The size of the labor force itself expanded, which means more people felt confident enough to actually start looking for work. And that's a sign of confidence, not collapse.
So the data truly has something for everybody.
Which is why it's such a headache for the Federal Reserve.
Okay, so what was the market's final verdict here? Did it settle the debate on whether the Fed should start easing up on rates?
Not even close. The data basically led to paralysis. If you look at something like the CME FedWatch tool, traders left their bets for a January rate cut mostly unchanged.
And what's that probability sitting at now?
It's holding steady, right around 25.5%. It's like a collective shrug from the market.
I saw a great quote from Gina Bolvin at Bolvin Wealth Management Group.
Oh, yeah. What was that?
She said, the data paints a picture of an economy catching its breath, and the consumers are standing, but not sprinting.
That sums it up perfectly. The market sees a slowdown, but not a disaster. Not yet, anyway.
And the market reaction on Tuesday reflected that ambivalence, that uncertainty, almost perfectly. The S&P 500 fell for a third session.
Down about 0.25%. The Dow was down more, maybe 0.62%.
But then, just to reinforce that mixed picture, the tech-heavy NASDAQ composite actually managed to tick up a little, 0.23%. The uncertainty is just running so high.
And we needed that context on the U.S. labor market because it gives us this baseline of domestic confusion.
Right.
So now let's pivot to the sources of, external clarity, or maybe more accurately, external shock in the commodity markets.
A perfect transition to geopolitical risk, because the biggest move overnight came after President Trump ordered this sudden, very sharp escalation of sanctions on Venezuela.
And that immediately rattled the oil complex. The rhetoric was certainly dramatic.
He designated the Venezuelan regime a foreign terrorist organization.
And then ordered a, quote, complete and total blockade of sanctioned oil tankers moving to and from the country.
Yeah, he's claimed that Venezuela is completely surrounded by the largest armada ever assembled. Definitely raised the stakes.
Rhetoric like that absolutely moves markets, and it moves them instantly.
So what was the quantifiable impact? What did we see in energy prices?
An immediate surge. Crude oil prices rebounded sharply from what were near 5-year lows.
Okay.
Brent futures climbed as much as 2.4%, pushing towards $60 a barrel. And WTI futures also jumped about 2.5%. It's a textbook supply threat reaction.
But is this price surge sustainable?
That's the key question, and that's where we need to get into the nuance. So experts like Andy Lipow, they estimate a full embargo could take about 800,000 to 900,000 barrels per day off the market.
And what does that translate to in price?
Maybe a $2 to $3 per barrel increase. But, and this is a big but, the global surplus really limits how high prices can go.
Right, there's a cushion.
A big one. The consensus is that there's a standing global surplus of about 2 million barrels per day. So the overall market disruption is capped unless things escalate even further.
But there's a wild card here, isn't there?
A major wild card, which the experts pointed out to CNBC, China.
Because they're the biggest buyer of Venezuelan oil.
The largest ultimate buyer, yeah. They often get it at a deep discount. So if Beijing is reluctant to observe U.S. sanctions, which they have been in the past,
Then the Venezuelan crude could just keep flowing.
and that would really dampen the price effect of the whole blockade. Honestly, the market is watching Beijing's actions much more closely than the White House's words right now.
And it wasn't just oil. These tensions drove a classic haven rally across the whole commodity complex.
Absolutely. When uncertainty jumps like this, capital just flocks to what it sees as safety. Gold rose toward that record high it set back in October.
Which was what, $4,381?
Right, and it's currently trading near $4,330 an ounce. This rally, according to Bloomberg, is being driven by a trifecta of factors.
Which are?
Geopolitical tension, obviously, but also persistent inflation pressures and, importantly, continued buying from central banks.
And silver hit a new peak too.
It did, and platinum had an interesting story as well. It surged to its highest level since 2008.
That was partially driven by the safe haven rush, but there was a technical driver there too, right?
A big one. News of a proposed EU easing of auto emissions rules. Since platinum is a critical component in catalytic converters, that suggested a boost in industrial demand on top of everything else.
And just to layer on the risk, the Venezuela news isn't the only geopolitical front we're watching.
No, the U.S. is also preparing for a second set of major sanctions, this time targeting Russia.
Which creates a really dangerous double layer of supply uncertainty for the market.
It does. The U.S. is preparing new sanctions aimed specifically at Russia's energy sector. They're targeting the so-called shadow fleet of tankers and traders.
And that's what Moscow uses to get around the existing oil caps.
Exactly. This is being positioned as leverage. It'll be enacted if President Putin rejects the proposed Ukraine peace deal, adding a second massive geopolitical supply risk into the global oil calculation.
Okay, so from the volatility of crude and commodities, let's pivot to the volatility of capital, specifically the just astronomical sums being poured into the global AI and tech investment race.
The numbers are almost impossible to grasp, and they are triggering some serious warnings.
And these warnings feel warranted just because of the sheer scale.
Oh, absolutely. I mean, you have Jim Cramer on CNBC expressing serious concern about what he called the reckless, imprudent data center spending.
And that's aimed at all the big hyperscalers.
All of them. Amazon, Microsoft, Google, Meta, and of course that OpenAI and Oracle partnership. What's just astonishing is the scale of the commitments. OpenAI alone,
What's their number?
their infrastructure commitments total close to $1.4 trillion.
$1.4 trillion for one company. That sounds less like a smart investment and more like a race to the bottom using investor money.
Well, that's the core question. And Kramer's focus on Oracle here is fascinating because he thinks he sees a potential choke point.
Okay, how so?
Oracle is weighed down by, in his words, a huge amount of debt. They just issued an $18 billion bond.
And after that issuance, Wall Street saw what's called aggressive credit default swap buying. Let's pause on that. For listeners who don't follow bond markets, what does that actually mean?
It means investors are actively paying a higher premium to insure Oracle's debt. They're effectively betting that the company might face a credit downgrade or even risk failure on its debt down the road. It's a clear sign of market anxiety about Oracle's balance sheet.
So, if Oracle is already under scrutiny for its debt, are the big AI players basically just outsourcing their own balance sheet risk to their suppliers?
That's a very sharp way to put it. Kramer's whole argument is that this balance sheet pressure might be what forces Oracle to show some discipline. As he put it, Oracle can't risk blowing up its balance sheet for Sam Altman, which would then force OpenAI to prioritize its business goals and maybe slow this whole build-out down.
So the bond market, not competition, could be the speed bump for AI.
It's a fascinating theory, but in the meantime, the frenetic spending just continues. We just saw more partnership news.
Right, OpenAI is now in talks with Amazon.
For a potential investment of over $10 billion. And this is notable because it would force OpenAI to commit to using Amazon's own specialized AI chips, their Inferentia and Trainium lines.
So it's not just about the money, it's about locking up proprietary compute power.
Exactly. It shows the giants are racing for exclusive, captive computing resources to get an edge that, generic infrastructure just can't match.
And speaking of tech hype just completely overriding financial reality, let's look at the autonomous vehicle market.
Oh yeah, Tesla.
Tesla closed at a new record high, $489.88, a jump of over 3% on Tuesday. And that rally is mostly fueled by Elon Musk confirming driverless robotaxi testing in Austin.
And that AI vision is generating this massive market cap. What is it, $1.63 trillion now?
Something like that.
But the hype completely ignores the underlying fundamentals of the car business. I mean, according to Cox Automotive, U.S. EV sales for Tesla actually dropped to a 4-year low in November.
So the valuation is purely based on the promise of future AI revenue.
100%, not on current car sales. But many analysts would argue, yes, this is just ignoring painful lessons from past tech bubbles, but the market is clearly addicted to the AI story.
And its rivals are trying to cash in on the same hype.
Of course. Waymo, which is Alphabet's unit, is leveraging the same optimism. They're reportedly seeking to raise billions at a valuation of at least $100 billion. It's a capital sink, but investors are happy to keep writing checks.
And while the U.S. titans are locked in this trillion-dollar spending spree, Asia is showing its own version of AI enthusiasm.
One that's very much tied to national ambition. Chinese stocks, specifically the CSI 300, rallied sharply, up 1.8% on some phenomenal IPOs for domestic chipmakers.
This takes us back to that geopolitical fragmentation theme.
It really does. So a Chinese GPU maker, Medic X Integrated Circuits, it soared almost 700% on its debut in Shanghai.
And that followed another one, More Threads, which surged over 400% earlier in the month.
Right. And this investor frenzy, it's not just standard growth speculation. It's explicitly tied to Beijing's political goal of creating a completely self-sufficient semiconductor ecosystem.
They want to replace NVIDIA chips after the U.S. tech curbs.
Exactly. The enthusiasm is heavily nationalistic. It's a signal that the global AI race is also a geopolitical self-reliance race.
Okay, let's move to our final area. Divergent consumer stories. We can start in the UK, where the latest inflation data looks like good news on the surface.
But it's masking some really deep underlying economic pain.
So what's the headline number?
Inflation cooled sharply to 3.2% in November, which was below the 3.5% forecast. And that fall is boosting the odds that the Bank of England will cut interest rates this week.
Probably by 25 basis points, a quarter of a percentage point, which would take the rate down to 3.75%. That should bring some consumer relief.
Eventually, maybe, but you have to connect that one data point to the broader context of UK growth, which is just stubbornly weak.
The economy actually contracted in September and October.
By 0.1%, yeah, and the job market is really struggling. Unemployment is at 5.1%, which is the highest it's been since January 2021.
And the stock market performance just illustrates this two-tiered economy perfectly.
It's the clearest chart you'll see. The FTSE 100, which is full of those big multinationals, is having a great year, up 18%.
The FTSE 250, the one focused on domestic UK companies, that really reflects the health of the consumer.
It's muted. It's up only about 7%. And even more telling, you look at consumer-facing retailers, the places people actually spend their money.
Like Greggs, Domino's Pizza.
B&M, all of them have seen their share prices drop 40% or more this year. That is just a brutal illustration of how hard-pressed the UK consumer is right now.
Okay, so let's pivot halfway across the world to China, where the consumer story is just as contradictory.
It really is. On one hand, general consumption gauges are falling to their weakest level in nearly 3 years.
But American membership warehouse clubs are absolutely thriving.
This is such a fascinating microtrend. So despite that broad spending contraction, these huge warehouse clubs like Sam's Club and Costco are drawing massive crowds.
Even though they have to pay pretty steep membership fees, right?
Yeah, between 260 and 680 yuan. And Walmart is responding to this by planning its fastest ever Sam's Club expansion in China.
Why is this model suddenly working now? Chinese consumers historically favored, high-frequency, small basket shopping, and online retail is king.
I think it speaks to a shift towards seeking value, but also seeking curated premium goods that online rivals just struggle to replicate.
And there's the experience factor.
Crucially, yes, the physical in-person shopping experience. One partner in Shanghai described it as a treasure hunt. She said, it's more of a, let's go to Disney here.
So they're paying for quality and experience when everything else feels so uncertain.
Exactly. But that thriving little niche stands in stark contrast to the grim reality for China's youth.
Yeah, the numbers there are still very bad.
Awful. Youth unemployment for urbanites aged 16 to 24 has been stuck above 17% since July.
And that pressure has created some just unbelievable competition for government jobs.
It's created an almost unbelievable display of economic distress. You had 3.7 million applicants recently compete for just 38,100 entry-level government roles.
That ratio alone tells you everything you need to know about private sector job prospects, regardless of how well Sam's Club is doing.
It really does.
Wow, what a dense but absolutely critical deep dive today. We started with that beautifully balanced contradiction in the U.S. labor market, where both bulls and bears could find plenty of ammunition.
Then we shifted to those inflationary geopolitical risks, specifically the sudden sanctions on Venezuela and the looming threat of more against Russia's energy sector.
We moved from physical commodities to capital commitments, analyzing the massive and, as you said, potentially reckless global AI build-out, a frenzy involving trillions of dollars.
Where the balance sheets of suppliers, like Oracle, are now becoming potential constraints. And finally, we contrasted that struggling UK consumer with the very specific, thriving warehouse shopping niche in China.
So to bring it all full circle, let's go back to that theme of confirmation bias we saw in the U.S. labor data at the start.
Okay.
We spend all this time analyzing these complex economic figures that can legitimately be spun in either direction. So consider this final provocative thought for you, the listener.
Let's hear it.
Robinhood's prediction markets platform is expanding. They now offer parlay bets on NFL games, and they're looking at allowing users to combine bets on non-sports events, including economic data and elections.
So if the fundamental economic data itself is already so subject to interpretation and confirmation bias, what happens when you legitimize prediction markets for that very same data? How does that change how investors view factual financial reporting?
Does it blur the line between economic analysis and just pure structured speculation?
That is something for you to mull over as you navigate these very tricky markets.
We'll see you all tomorrow morning with new headlines from major financial magazines.